Good afternoon, ladies and gentlemen. I hope you're all refreshed and enthusiastic, ready for the next session. My name's James Duddridge. My job is to keep order if you become disorderly, so consider that a threat. But also, my only other job is to introduce a very modest lady, Sheena. Sheena is the Chief Growth Officer of Cusa One, which is an Agritech company that focuses on digitizing the whole value chain, not only through technology, but also through people on the ground, agripreneurs, a term that I was unfamiliar with. Sheena is very modest, but also, unlike most people that have been lawyers, very truthful and honest. And so talks of her background as an entrepreneur, but particularly talks about her failures as an entrepreneur and how that's helped shape her and her view of being an entrepreneur. So she will be looking after you, introducing the panel, and I will just sit in the sidelines and be there in case of emergencies. Sheena.
Great. I hope there are no emergencies. That would be quite worrying. And we do have the 2 o'clock panel, the one after lunch. So we're going to try and rivet you and keep you awake and energized, because this is a topic that is really, really interesting. So as mentioned, although so I'm an entrepreneur, I've been an investor, I worked for the government, I worked for FCDO, I do a lot of government advisory work for the Kenyan government, but now I'm back to being an entrepreneur and on this panel, and that's why my questions are going to be from an entrepreneur perspective, challenging all the capital in the room. And so in order to kind of start that, I kind of wanted to sort of first set the context very quickly. And then, just to make it interesting, entrepreneurs have to pitch to a room full of investors. We call it the elevator pitch. So I'm not going to be doing the introductions, but each of our investors are going to do their elevator pitch, introducing themselves and their organizations, just so that they know what it's like to be in our shoes. But to set the context, it's great. I think this is such an important topic. When we think about agriculture, and of course, agriculture in Africa, all of a sudden, everybody's image kind of just goes to the smallholder farmer, the lady, the woman with the, the bag on her back. And then you hear this conversation around tech and technology, and it's kind of hard to sort of merge the two, but it's a really, really interesting space. I'm in that space, Agtech, and it sounds like an oxymoron, but like it is, unfortunately, technology being an enabler in a very, very difficult, space. As is in this room, there's a huge financing gap. How do you fund what is known as the most risky sector as a sector, but then also in a continent, Africa, which again suffers from a high risk perception. That's something that we want to see. And lately we hear this conversation about how Agtech is going to unlock everything. And that's something else that I'm personally a bit cautious about. I think tech is a great enabler, but this idea that it's a silver bullet that's going to solve something that's solve the challenge of agriculture is also, I think, a little bit I think a little bit overrated. So the question then is, has Agtech truly shifted the risk or returns? Is it more about, or is it just still on PowerPoint? And this is where our panel is going to come in and discuss the financing issues, the reality on the ground, and the tech piece. So because you don't want to hear me speak, we're going to start with elevator pitch, and maybe we'll start from this way, and then I can, and then we can go.
Thank you, Sheena. So my name is Madeline Withiga. I run a facility called Adapter Climate Finance Facility, headquartered in Nairobi, registered here in UK as well. So my history is in banking, 29 years of not wanting to fund farmers. So when I left, my regional role at Standard Chartered, taking care of SMEs across 14 markets in Africa, well, my conscience beat hard, and I went and set out to do what needed to be done to unlock finance to smallholder farmers. So founded this company 6 years ago, and we are building, or rather we have built technology that's helping manage risk by appraising the farm. So apart from the farmer, so that banks will traditionally do their scoring for the farmer, and then I have a technology tool that then checks what soil, water, biodiversity, and climate risks exist in the specific farm, so that we also have a score for the farm, specific to crop and location, and livestock. Actually, the only livestock we are not doing is bees and fish in water, because those environments, we haven't yet cracked how do we appraise risk in the ocean yet. And so right now have done 9 projects, and we are looking to continue scaling that by ensuring that when farmers are pre-screened, then we are able to place capital in their pockets for them to actually continue being productive sustainably, as well as resilient at the same time. So we cannot not look at the resilience angle, given the climate vagaries that are there. So that's what we are doing, and currently actually looking to raise capital for fast loss, because to unlock the appetite of banks, we have partnerships with 9 top SACCOs and tier 1 banks in East Africa. So we are looking how do we absorb the lower, the precipitate risk, by having a fast loss pool of funds to also ease the collateral need for farmers, because that's also a challenge for farmers to raise collateral enough for the lending. Thank you.
Amazing. And
all right. Thank you very much. My name is Deji Adebusoye, and I work with a firm called Sayal Capital. We've been in the food and agri-investment space for the last 13 years, starting with investing through a growth equity strategy in Nigeria. We've fully deployed the funds and the capital now, and we are about to close on a second equity fund, but now we're expanding that into the rest of West Africa. On the back of that, I lead a separate fund, which is our impact fund strategy, which is called Social Enterprise Fund for Agriculture in Africa, where we provide mostly private credit to companies across about 13 countries in sub-Saharan Africa. We've been doing that now since 2021, actively from 2023. And our thesis is really how can we, as a firm, Sayal Capital, how can we bridge all the financing gaps? You talked about the financing gap, and we are going for all the opportunities that we see, not because of the opportunities, but because if you don't solve across that entire financing landscape, you're going to leave something open, and some people are going to struggle. So when we started with the impact fund strategy, we look at people or companies that are looking to get the capital they need to get that lease of life to grow, but they've been staffed by banks to get the capital. So we provide that capital to them, and then once they're able to, get their businesses up and running, and they're looking out to power and grow, we now have the equity fund that can also support these businesses to scale and to grow their businesses much further. So it's a pleasure to be here. Thank you very much for having me.
Great. Thank you. Over to you.
So my name is Casper Havinga. I'm the investment director for the Agri3 fund. And Agri3 is a blended finance impact fund based in the Netherlands. And what we do is we provide de-risking instruments, so essentially guarantees, to financial institutions that are active in emerging markets worldwide to enable them to finance and support the transition of the global agricultural food supply chains towards more sustainable practices, because a huge transition is necessary there. And we do that by partnering with these financial institutions to help them to finance companies and projects that prevent deforestation, promote more sustainable production practices, reduce carbon emissions, and support rural livelihoods. And we do that by providing these guarantee instruments, but we also have a technical assistance facility where we can help either the FI or the final beneficiaries to improve their business, to take action, to better measure and implement impact. And so as I mentioned, we do that both Latin America, Africa, and Asia, and really also actively growing our business into Africa.
Great. Last but not least.
So yeah, my turn. So my name is Luc-Étienne Dandrieux. I'm the general manager of AFSIC. We are a Swiss-based non-profit investment company. We mobilize philanthropic funds to invest in small companies in Africa in the agribusiness side, with the idea to help this company with a hands-on approach, not only with capital, but also with our experience. I have personally a food science background, not at all in investment, and I'm still learning as we speak. So AFSIC is a 3-year-old company, and we are building our pipeline. We have 3 investments now in equity, with the idea really to create jobs, to develop the industry and the food industry in Africa, helping small companies to grow and bring them also the competencies we can help them to develop.
Okay, great. So you can see that we have a whole stack of capital. So we've got from the banking, philanthropy, we've got funds, we've got risk mechanism through guarantees. So we're really covering a good financial range of instruments, which I think is super exciting. But maybe we'll start with you, Luc-Étienne, then. From the philanthropy side and from where you sit, where do you see the biggest kind of blind spot in how capital currently flows into African agribusiness? And where does this role of philanthropic capital sort of play in scaling agribusinesses?
Thank you for the question. I think, well, I would see 3 blind spots. One you mentioned already during the introduction is this lack of capital in the missing middle, where companies are too small for private equity or bank finance, or too big for microfinance. And that's where, I mean, agribusinesses, most of them at least, or the one with potential are. So there is this blind spot where, I mean, there's lack of capital there. The second one is for me also how we maybe tend to prefer innovation or things that are a bit fancy compared to execution and what is really needed in terms of developing really the production capacity, building factories, developing supply chains. And yeah, Agritech is great, but it's, as you said also, it's not a silver bullet, it's really an enabler to develop I mean, real execution and the industry. And maybe a third one is the misperception of risk, where, I mean, of course, there are risks, but it lies more on the execution and on how cash or working capital is managed. And so there is definitely a place where I think philanthropy and philanthropic investment can, I mean, somewhere that we can really play a role is here to absorb the early risk, so to de-risk some of the investment by financing technical assistance, by also doing feasibility studies or absorbing first loss. Also, potentially also on funding, investability, I mean, to help companies to become investable through farmer training, through Agritech pilots. I mean, there are different ways also to do that. And finally, this can enable a blended finance. So philanthropy is part of, I mean, not there to give charity, but really to build the ground for further investments afterwards. I mean, so to close the gap that we can see there.
Yeah, no, I agree. I think, as we've been talking about it, agriculture is risky. Agriculture in Africa is even riskier. And so there is this need for this capital to kind of make it easier to help those businesses grow, because at the end of it, the agri-businesses are at the heart of it. So that goes really well into Casper, and in terms of you coming from the other side, which is guarantees. So I guess my question here is, are guarantees are meant to incentivize risk-taking, right? And so risk-taking, so Agtechs, for example, would be a good example of what's traditionally risky. So do guarantees really incentivize risk-taking from banks or other regulations, like the Basel regulations, et cetera? Even with the guarantees, do people still just pick, the safe borrowers? Or actually having a guarantee means, yeah, these Agtechs and other businesses, are getting the funding that they need?
Yeah. No, I think it's a very good question. And I think we have to also acknowledge the realities that we often talk about perceived risk, and that guarantees can help for banks to find out that actually the risk is not so high and they can happily continue then without the guarantee. But the reality is that there is a real risk in agri, and specifically in smaller agri, in areas with high climate risk. So that there is a higher risk associated to it. And also the reality, I think I especially see that a lot in Africa, that banks have plenty of alternatives to invest in. So yeah, if you can make your money with investing in government bonds, why bother going into more difficult places, even if there's money to be made? And that's something that you cannot change just with a guarantee. Yeah. Right? And the same also on risk-taking. From our discussions with banks, we understand that they mainly see a benefit of guarantees for borrowers that have a lack of collateral, so that they are, in essence, good borrowers, but for plenty of reasons there's a lack of collateral, and that's where guarantees can help, and that's great. But it doesn't yet change them from moving into the higher risk sector. So that's a reality, and that means that more than guarantees is needed to bring things together, to provide incentives also for banks to do it. And I mean, there are a couple of initiatives and examples. I think the AFSIC guarantees, they have shown also with right incentives, they have been able to move banks a bit towards agri, but it's not automatic, right? Yeah. But I still believe, I mean, there is a huge opportunity. I mean, if you see the potential and the untapped potential of the agri sector, not only Agritech, but also agri in general in Africa, there's a lot to be done. And as competition increases, more and more banks will see the opportunity in that sector. And that's where guarantees can play a role to help these banks to more quickly make the steps, to step in where they are needed. Because that's also, if you talk about Agritech, of course, capital needs to come in the right moment. I mean, if it's early stage Agritech, you need VC capital and growth equity. I mean, that's everywhere around the world the case, but especially when they develop more stable cash flows, they have a need for working capital financing. I mean, that's exactly where the right type of capital should come in. And that should, I think, not be hard currency, long-term development finance, but it needs to be short-term working capital finance linked to their working capital assets. And that's where local financial institutions are best placed to provide that. So I really think that by providing the right guarantees, you can provide the incentives for banks to move more in towards that space.
Yeah.
Another example is with Agritechs that are engaged in farmer lending and set up pools of farmers to lend to, that you can think of more sectorization or SPV structures where you pool farmer loans, you bring in first loss capital, a mezzanine guarantee layer that then catalyzes senior funding to grow this business. So that's where guarantees can play a definite role at the right moment to support these businesses.
No, I think that's a really good balanced answer. And you're right. It's one tool that needs to be working with a range of tools, but especially around the agri-lending, that can be a real enabler. So I think, and we're seeing more and more of those kind of businesses, and with the credit scoring that you've mentioned, it could be a really good combination. But Deji, then over to you, and I think I kind of touched upon this when we started. There's this huge excitement around Agritech. Like nowadays, I don't like to tell people that I'm the chief growth officer. I mean, I'm 5 foot tall, but I'm the chief growth officer at an Agtech. And I'd like to now play that down because there's a lot of excitement around Agtech, AI, precision farming. There's so much, and it is super exciting. It really, really is. But from your experience, have these technologies meaningfully shifted the risk or the cost curves, or in Africa, or is it still mainly kind of PowerPoint and pilots?
Yeah, thanks. There's this funny saying that I think we're all familiar with that says, show me your friends and I'll tell you who you are. I always tell people that in the world of investing in Agtech, when you're looking at an Agtech, I'll say that show me how much you're paddling like crazy and I'll see if we should invest in you. Because I think in the context of Africa, agriculture, unfortunately, is still way behind the yield curve, right? So it's still extremely important to build certain infrastructure for you to be able to layer on tech. You can't just look at tech as an isolated, offer that you are providing. But having said that, there is over $100 billion gap that we are looking to bridge in the ag market, the ag sector in Africa. To the question whether Agtech is all that excitement, I think it's getting there, but it's going to take a lot for you to cross that hurdle. There are incremental gains we are seeing. Maybe they are not yet transformational, and I think there's a bridge for us to get to that point where it begins to get transformational. And I will give examples. So areas where we're already seeing the incremental value of Agtech, for example, is in last mile distributions. You see things around route optimization. You see things around digital orders that is reducing drop deliveries. And these things are helping to reduce the unit cost of operations when it comes to Agtech. Another area which you talked about is around monitoring, screening. You are beginning to see companies like Adapter that are providing credit scores. Those are helping to lower the cost of acquisition of customers and is giving more strength. Credit guarantees, for example. We are beginning to look at how those can be, how technology can be leveraged to make those more accessible to people who need them. So these are some of the areas where Agtech is already beginning to show. One other area which I think is very, very popular is around embedded bundling. So you see people pulling together things around credits, inputs, the agronomy advisory, offtake, pulling it together in one product offer and making it available to the customers. What that does is it helps to translate the credit risk into an operational risk that you can then manage. Because you don't have the tools to manage the credit risk as effectively as you should. We are seeing all that happening in the market. The areas where there are the challenges are still around macro headwinds. You can't use digital tools to hedge against FX risk or policy mismatch. All those things as weather, drought issues, flood clusters. These are major issues that are happening in the market that still needs to be addressed. So to summarize, I would say that there are incremental values we are seeing with the advent of Agtech, but there's still a long way for us to go to begin to see it become truly transformational on the continent.
Yeah, no, I think super well summarized. And I always say this to people, right? You can't eat tech. But at the end of the day, the technology that you've kind of described, where it's an enabler, where technology can help make Africa get to those places, faster, whether it's reducing costs, increasing efficiencies, those things are the kind of game changer and super exciting. But it might not be that flashy drone that you see, it has to be built in. And I think finally, I hear this a lot, and with sort of investors and kind of entrepreneurs, I'm disrupting the sector, and I'm just like, let's build the sector, and then you can disrupt it. Yeah, because we in Africa, we haven't even got the sector built. So let's use tech to build the sector, and then the next generation of techies can come and disrupt it. But yeah, so I think, I think that's where, yeah. But now over to the more traditional. So being a banker for 20 years, that's worse than being a lawyer. There's a banker here. They're worse than me. So from 29 years of being a banker, as you said, especially in Africa, very, very averse to lending to the farmers, and just forget the farmers, the sector generally. But it's amazing that you've gone right down to the kind of farmer producer level. I'd love to kind of hear. So how, where did you spot the opportunity? Did you, how does that now relay into, to what you're doing? Because it's a very big mindset shift, actually. I wish more bankers would want to become farmers or lend to farmers.
Yeah, I know. My family thought I was crazy, Yeah, so somebody actually mentioned, I think, about, the cherry-picking tendency in banks, even when there's capital supplied for impact.
Yeah.
We would end up looking at what are the easiest sectors. And when funds came specified for the agri-sector, we would want to deal with the manufacturers and the big export farms and the processors. So there was still a very high number of unaddressed millions of smallholder farmers. And you can't, we've talked about the risk here, it's inherent risk, perceived, yes, but also real risk.
Yeah.
And really, I think in terms of then what do we do? Yes, before we say we are disrupting, what do we do at least even to unlock flows of capital there? Deji mentioned about the gap that still exists in the billions. And so, it's not a very easy to address sector, and tech had to come in, but not tech for the sake of tech.
Yeah.
In fact, we started off by building, with the support of the Gates Foundation, got a large grant, and I'm not a scientist, so we got support from CGIR, which is a conglomerate. I think most people are familiar with CGIR. And we built this tech tool and then realized it's not going to be relevant just dishing out more information to farmers. So there will be a lot of research and information on one side, and then the bankers on the other side, and this vacuum of, of a gap. So to cross that, so we thought, and I want to just emphasize what I believe Caspar said, there was still a need to see what stacks of capital come in to address this, and special purpose vehicles, I think, become very relevant here, and banks are opening up, yeah? Me, on the other side, would look at, say, Propaco, just to maybe pick a name, and say, you know what, so you bring in the dollars, but we are gonna just make sure we are deploying this to the very less risky agri-enterprises, you see. But then now, how do we now stack capital, including fast loss and guarantees, and then ensure that the banks, which is what we are doing, we are ensuring that the banks also put in their dollars, so everybody's skin is in the game. And then there's mezzanine, or call it concessional debt. And in that, I think the farmers' contribution is also important, because smallholder farmers, I think, kind of to break that jinx, also need to look, apart from the capacity, there's been a lot of capacity building, and farmers want of, just more and more knowledge, fine. But why don't we now also ask them for their equity in terms of their participation? So I think creating that sort of innovation in finance, we've seen it begin to bring change. I liked what you say, before we disrupt, can we even start? And, working with about 3 top circles and 2 top-tier banks in 2 countries in East Africa as part of our pilots for the last 6 years, we have seen when you compare a control group of farmers that are being funded in that mechanism versus the traditional lending, there's less non-performing. Actually, the non-performing loans on the traditional side is 10-15% loan loss, and on the one that we are using to, to propagate finance in a different way, we are seeing under 1% loan loss. Real figures, and this is our earliest projects. We started with the hardest to go places in the northern rangelands, where agro-pastoralists, pastoralists have no idea about agriculture, so we turned the women into agro-pastoralists. And the men go out to pasture, then the women, we taught them, using this tool, we can actualize, agriculture. And so long as we can find water, and that was easy through the tool because the Agri-tool has water maps and soil maps, and then we combine that score to create a mathematical output and a PDF that says, how do you grow melons and grapes in a place called Turkana, which is very dry, under 100, I think, mm of rainfall. And so by and by, we've seen that, it's becoming real. But that was proof of concept at the very early stages. We said if we are able to turn people who've never farmed before into farmers, then we can as well go into the Central Highlands and the other places and see what do we change, and that change is definitely.
I love it, and I think you hit the nail, right? It's let's stop thinking about sort of farmers and start thinking about agri-businesses.
Yes,
and that's what
exactly.
you did. And they got skin in the game, and then they got financing, and then they got ownership.
Exactly.
But I think that's, and I think that's a great example of sort of when you kind of shift things and use technology, but not kind of technology on its own.
Yeah.
But it started with the kind of Gates Foundation funding, which I think is interesting. And going back to sort of philanthropy then, when you look at sort of returns versus impact, a lot of the times I meet a lot of kind of investors, and they're impact investors, and then I look at their returns expectations, and I'm like, are you really impact investors? I'm not really sure, that you are. But you're doing this, you're funding sort of the early stage, risky kind of agri-businesses. So what's kind of realistic in terms of kind of, given that we are smallholder dominated, given that there's weak infrastructure, given that we haven't even built the sector yet, can agri-businesses actually deliver the multiples that investors expect, even when you count all the cool tech innovations and ag tech, et cetera? Is it realistic?
That's a good question. Well, there might be a short answer, but it's probably not the right one. But, because I would say no, in the sense that the issue I would say is what is the benchmark we use. And if we compare Silicon Valley type of multiples, for example, where you don't have such costs maybe on infrastructure and not the same environment, it doesn't make sense to compare market type of return versus what you can expect from companies or agribusinesses in Africa. Maybe also, if we compare, what we've done in Europe, or how we extracted from the soil and destructed our environment, is it the right way to do businesses? I would not, and we tended to disconnect impact or reality or environment versus the return or financial return. I would say we need to have a different way of thinking for that, where we can have return, we can have a steady, good return, but we cannot have the same level of returns that short-term investment can have. So it's either yes and no, but we can definitely have return, and there's something that is linked to impact, which is it's definitely a way to de-risk the investment you do. Well, you invest in your environment, when you invest in the people, when you take care and share the value and not take it all for yourself, for sure, it will last longer and can last forever somehow. So there's, I think, definitely a need to adapt our expectations, maybe be less greedy, and think that, okay, well, single to low double digit might be feasible, and it's feasible, but you don't go for 15, 20%. It doesn't make sense. And then there is a time horizon, which is also important. If you think, you want to exit in 5 years, maybe not the right industry to be in, and maybe not the right, also for any kind of industry actually, way of doing business. So if you think more 7, 10, 20 years, So like being patient in your investments.
I think you're spot on. I think too many times the conversation is around, African kind of entrepreneurs or African sectors having to adjust, but sometimes it's okay for even the people with the money and the capital to also adjust their expectations. And I think that's really great. And I think both things that you said, not just the return expectations, but also the time horizon, because actually maybe in 10, 15 years, that return might be made and more, and also all the environmental return. So I think that's a really good answer, actually. So far, that's an awesome answer, I have to say. I love it. Not that everybody else's answers haven't been good, but clearly that was great. So now over to you, Casper. Then, I think now it's kind of, and we sort of touched on it, but like how do we balance like the global capital sort of mandates with the local realities? And I think we touched upon this, like climate change, droughts. I mean, it's real, right? It's happening. Previously in Kenya, we could measure. We knew when the long rains were coming and when the short rains were coming, and our grandparents could predict it like you wouldn't believe. But things have really, really changed, and there's been price shocks, and there's been wars and instability. So how do you kind of balance all that risk, and especially when you're financing, agriculture, even if it's technology enabled? So how do you kind of manage the global, and the local realities?
Yeah, of course, that's a great question, and something which is very much also what we are trying to do as a fund, because we have investors that are large global parties that speak about SDGs and climate change, but of course the projects we support are on the ground and in the reality of where they have to produce locally. And that's also why Agri3 focuses on working with the local financial institutions that have the local presence, that know the local situation, because you have to have that local adaptation if you want to be able to address these challenges. I think that's one of the key things. And also, that if you talk about Agtech, I mean, a lot of tech solutions in other sectors can be designed behind a computer somewhere in Europe or in the US, and then you can scale it globally within no time. But ag is still in the soil, and it needs a local adaptation. I think there are no easy solutions that you can just scale around the world. You still have to be present locally and adapt to local circumstances. I think that local adaptation is really a key thing of all the solutions that we're trying to design here. Another thing I think is also awareness of all these risks that you mentioned, because they are there, but what does it mean in practice, right? And that's also where I think both banks and companies need to gain more awareness of. That's something that we also have been supporting as Agri3. This is not in Africa, but an example in Peru, where we're working also to build a program to provide drip irrigation solutions to local producers, together with a bank and equipment suppliers, where we are also building a water risk impact assessment to help these banks and also the equipment suppliers to understand which areas can produce also in 10 years from now, or where is the risk really high? Because you also have to make choices there, right? If there's no water, even drip irrigation doesn't solve the issue. So it's also really about building awareness and using the knowledge that to know where are the risks specifically. But then finally, you also need to have flexibility to adapt to when the risks happen, because that's part of agri. And that requires, I think, on the one hand, flexibility in structures. So it needs long-term financing structures that allow farmers to absorb a year of shock, and flexibility to adjust, a repayment if necessary. I think that's one of the reasons that all successful agricultural banks have been able to make these adjustments, right, to adapt to these realities. But also as investors, so that's also why Agri3, we have a blended finance structure with concessional capital from the government that allows us to also absorb a hit if it might happen at some time. So I think these combinations are really crucial there.
Yeah, no, and I think you're right. It's also understanding the awareness, and then how do you mitigate them? And sometimes it might be actually, you're right, you have to walk away, because no amount of tech solution or irrigation solution, solar powered irrigation, if there's no water, that's not going to solve it. But I think that's a really fair point. Excellent. So I think maybe I'll move on then to Deji. So from your portfolio, as you said, you've done quite a lot of this investing. Where do you see kind of the strongest pipeline, of investable agri SMEs today? And again, you don't have to say it's the tech-enabled models, but are they leading the way, or is it still the more kind of traditional segments? Like as an investor, or to kind of the investors in the room, where is the strongest, like where's this pipeline coming from? Like what excites you?
I would say that there's an increasing number of ag tech options that are coming on board that are getting quite exciting, but we are still very much, I think, in the traditional phase because, like I said earlier, there's still a lot of building that needs to be done. There's a lot of infrastructure that needs to be put in place, and just slapping on technology without those underlying infrastructure is quite challenging to be scalable and to be successful as a business model. And one of the things I was going to touch on even to this point is the question you asked around impact returns, because it plays in how we think about the build-up of the portfolio. The reality is that you're building a portfolio of investments, but there are certain expectations from the market, and that's the capital market, for example, in terms of your credit losses that you have to carry on your books. Unfortunately, that cost has to be borne somehow, one way or the other. And as an investor, you are pricing that risk into your investments, and so that has an impact on how much you can, price to the borrowers at the end of the day. So if we look at our portfolio today, what excites us are people are real operators. Even if you're in the ag tech sector, you need to be an operator. And I'll give some examples. There is an ag tech company in Ghana that we invested in. Basically, what they initially started with was they were a marketplace, and I'm sure many of us have seen the advent of all these marketplaces. They work very well in every other part of the world. But if you just start up a marketplace without the underlying infrastructure, it's as good as dead on arrival. So they started that, trying to match people who want to farm with people who want good returns, sitting room farmers. And what happened eventually is that model started to fall apart. What they then decided to do was to now walk backwards, and they started putting in place things like, warehouses. They started putting bundles of input programs, crop programs, working with farmers, high-intensity work with farmers. And all of a sudden, their growth started. And that was because they decided to go a layer under that technology to build it out. Now, there's a cost to that, because normally in other parts of the world, you probably just slap on that technology, but now you're incurring a cost to be able to build that infrastructure under, and that's cost of doing business, that is in the country. But when we see that, we know these are serious operators that will build something in the for the long term. We have another ag tech investment like that in Nigeria, who did exactly the same thing, different model, but also went underneath and started building agent networks, building connection to warehousing, renting warehouses, creating logistic partnerships, just to make sure that things are working underneath. And you start seeing that scale. The initial investment happens in the first few years, and then they scale from there. So those are the kind of things that excite us when we look at the tech sector in the ag sector, yeah.
No, that's super exciting. And I think that's for us, for Kuza, that's exactly what we started with this farmer network. So we have this amazing network of 1.2 million farmers and these agripreneurs on the ground. And we thought, oh my God, now this is going to be super easy. When I joined, I'm like, yeah, we're just going to go to the market and ask all the agro processors, what do you need? And then we're going to get the farmers to grow what the market needs. And what that means is there's going to be value addition. So my vision was there's going to be like local decentralized manufacturing at village level. And this sounded like perfect, right? And I was just like, right, we're going to change Africa. We're going to create 1 million jobs. We're going to feed the world, and we're going to, make lots of money and create lots of jobs while doing it. Oh my God, reality on the ground, like transport, logistics, cold storage. And even when you have those solutions like the cold storage, a farmer would be like, well, why am I going to pay for this when actually I'm losing half my crop anyway to a broker or to something. So we had to really go back on the ground, and what we've created is we've had to do, the tech, by the way, the tech we have is cool. Edge computing, you don't need internet, and you can watch videos and train the farms. The tech, the data, it'll blow you away, the AI-powered stuff. But actually, that was the easy part. The hard part is exactly what you're saying, which is like building those relationships with the processors, building the relationships with the transporters, building the relationships with the input companies, and getting everyone to kind of compromise. Because like an agro-processor would say, no, I want this variety. Farmer would say, well, I can't grow this variety because when I grow it, I don't get the yield, and then they reject it anyway, so I'm not going to grow it. And everybody loses. So it's really, it's what you said, sorry, I'm talking more, which is apology. But really good point. We've got 5 minutes, so I think I'll kind of move on to sort of your question. And this is kind of a broad question, so take it as you would, but and global agriculture is heavily subsidized. Whether you look at the US, whether you look at Europe, it is heavily subsidized. In Africa, we can't afford those subsidies. Yes, we get some fertilizer subsidies here and there. But so then can African, agribusinesses, even the tech-enabled ones, can we actually really compete internationally?
Yeah, I think, and it's building up, yeah? And I think government has to come in. This morning I was actually talking to our Ministry for Irrigation and more or less tackling that same subject. And I think in the first and second worlds, a farmer is really a supported entity, you know, in a farm, yeah? So I think what needs to happen differently for Africa is several players coming together. I think it's what the panel has been talking about. And in this particular case, assume a smallholder farm is irrigated. So government can come in to ensure that the equipment comes in with a bit of tax subsidies, you know, some waivers, because it's supposed to be affordable, you know. So rather than becoming so commercial, how does the government come in to actually make the equipment itself affordable? And then that equipment can actually provide debenture to kind of, using the word loosely, subsidize the need for banks to raise collateral from the farmer. So if the farmer has put up this equipment and offered debenture in terms of security, asset securitization of the same, that's also something that has the banks now yielding a bit to not want land as collateral. Traditional land is very expensive, and for a smallholder farmer, most of them will have ancestral land that they don't have rights to. So again, think about, so how does the banking industry also ease out a bit on that? And then, of course, then the large funders, you know, coming in with what the banks would need in terms of de-risking. And, you know, so I think if we think broadly in terms of every player coming in place, I was talking to the minister and I was saying, then we can think about tech coming in, but not in a way that is charged to the farmer and it becomes not affordable. You know, as a public good, how do we come behind that effort to just make sure that if it's a value chain, it's supported, you know, supported by the government. So the government doesn't necessarily have to put up guarantees, although that's coming up in a bit of many countries in Africa. They don't have to actually do funded support. It can actually be by waiving and subsidy and letting go and easing some of these barriers to finance. Yeah? I'm conscious of the time. There's a lot to talk about the subject, but yeah.
And I'm hoping that this means we can still open it up to some audience questions. Excellent. Okay, so I wanted to end with the panel saying one bit each, but I think we would like to open it to the panel questions and then see if we can get some time. We have a great panel, guys.
Yeah.
Excellent, I think in front.
Hi, I'm John Shikatana with Pangea Africa, based in Ghana, working with agri-SMEs in West Africa. Very interesting panel, and it seemed to, in some ways, not be so much about Agritech, but about agri, which I think resonates probably with many of us. One question is really, what is Agritech? Is it irrigation and cooling and
drones,
improved seed, or is it drones and AI and apps and marketplaces? And my question is about, are we, and maybe not we on the panel, but as a community, overhyping Agritech? Because you do see in the marketplace in Ghana, at least, and maybe elsewhere, consistently programs that are focusing entirely on tech, on startups often, which seems to be perhaps another error in the space of agric, but there, you know, you have, for example, Agra and other programs that are really heavily focused on agritech to the exclusion of agric companies, producers, processors, and those resources maybe seem misplaced. So I'm curious to hear perceptions on, in the broader community of ecosystem supporters, is there too much hype, and do we need to help sort of put it in its proper place? Thank you.
Great.
I'm going to complement your question. So Ruby from Supiva. Supiva is short for Supporting the Divas in Africa. We're an impact investment advisory firm. So complementary to that question, I think that Deji made a comment that one of the key things that's still missing is infrastructure and making sure that agri-tech can truly thrive. And I guess we work with a lot of agriculture companies, but companies themselves that just, you know, looking at the basics of, do we even have mobile service? Do people even have smartphones? So how, like, so I guess the question is, what is some of the key trends in agri-tech that you see would be what is needed? And the other side of it is, I think, the overall cost. What's going to be the most cost efficient, cost effective? When we look at, we're working with a coffee company in Uganda right now, and some of the solutions were it didn't make any sense when it came to agri-tech. So I'd love to hear some of the perspectives based on the portfolio or some of the pipeline that you've seen, and including some of the portfolio companies that you work with.
I can try to answer the first question from John. And maybe this is the first question, what exactly is AgTech? And I would say that any technology enabling agriculture. So I think that's simple, but I think the longer answer is, we've seen across the entire spectrum, all the way from production to processing to distribution, sales, where people are building technology solutions that enables and makes those processes a lot more efficient. I think the hype came from the world where we started going into things like precision agriculture, machine learning, AI, and are those tools effective? I would say in the grand scheme of things, not as much as we want them to be, just because of that same point. There are certain level of infrastructure that is required to be able to operate at a proper unit economics for you to be able to lay on those level of technologies on them for them to be successful. But are there, machine learning, AI, for example, we are still struggling to find credit data in the market. These things requires massive amount of data for them to work, right? But we don't have that kind of data. We are still building. So what you're going to realize is that most of the advanced technologies that are being built, even in terms of AI and all that, will not be easily adapted to the African market because the data is not readily available. So is it complete hype? I would say no, because we need to start having those conversations, and we need to start looking at how those technologies what do they need to be successful? But to your point, if there's somebody who is just building out technology from with his pajamas in his living room and just writing codes in the world of agriculture, it's not going to work. You need to be out there, not in pajamas, but in your jeans and in your boots, doing the hard work on the ground, and then enabling that process with technology. Then you begin to see the process move the needle.
And can I add to that?
Yes, please.
So both, like linking both, yeah? So I talked to a drone farm that said that, thinking that tech needs to be drone heavy and all that, yeah? But then they say the crops have to be in a row and the rows have to be straight and it has to be a certain, so I said, this is not applicable to my smallholder farmer that I ignored for 29 years. So I think I decided to formulate tech as a tool, a desktop tool, where if I key in the location of your farm, specific to latitude and longitude, and key in the crop that you're growing or the livestock that you're keeping, minus bees and fish, then I'm gonna get an output that talks about, so we used a large language model to tell the tool, please feed back easy to understand farmer language that also makes sense to a banker. So it then suggests regenerative practices, yeah? How do we restore, so because it's a tool that is able to tell where soils are degraded, where water tables are depleting, where there's a lot of water or wind erosion because of lack of soil cover. So I think it's what you tell the tech to do, but if we sit back and say tech, it's not going to be affordable to a lot of the millions of people who need it, yeah? So for me, my interpretation was, can I build a desktop tool that also saves the bank costs to reach the farmer? Because that's baked into the cost of the loan for the farmer. As a banker, I'll try and really reach many farmers, but then I'll charge them for me trying to reach them. So this tool is able to visit farms at least and do pre-due diligence before we can do the one visit just to verify that things exist, yeah? So I think it's how we can also innovate the interpretation of tech and adapt it to the communities where we want it to make sense.
Yeah, and just to add, I think that's a great question, and I grappled with it. So I wrote the questions, and I really grappled with this. And I'm from an ag tech, right? And so for me, our tech is cool. We do AI, we do all that stuff. We incorporate so much tech. But for Africa, that wasn't the hard part. That was the fun, cool part. So yeah, that's why. But yeah, I take your point. So sorry if you were disappointed in not the tech conversations, but we felt that this was realistic to what we think Agtech as an opportunity, as a builder, rather than the shiny, cool Silicon Valley tech that everyone's used to. Yeah. Done. Yay. Yeah. Can they do one last point each, or do we have to stop? Yes. Okay. So thank you. So if we can just in like 10 seconds or 20 seconds each, if you can just say what you think would really move the needle for Agtech in Africa, what would that be? Just a quick.
So yeah, for me, the main thing I would say is patient blended capital. That would be the first thing to then enable Agtech or technology to help agribusinesses to strive being patient enough to see the effect and the results and the economic results, of these investments.
Great.
Yeah, I hate to repeat, topics that often come back in all the panels and all the conferences that are happening all these weeks, but some are really true, and that's of course a topic about data and availability is also mentioned. I think if we want to move the whole discussion about real perceived risk and getting banks to become more active, we need the real data to show what are the real risks, how can you address them, because only then you can move the whole topic of ag financing from risky to a clear business where that banks can absorb and understand and can work on. So I think that's still an important one to mention again.
Yeah, I would say that we need a lot more operators who can build, but to enable those operators, we also need tools and solutions that will help capital providers to be able to make capital available to them, to be able to power the growth that they need to deliver their value.
Yeah, so for me, I think, so we are just a small representation of the many players in the camp trying to sort agri through tech. So my call would be, how do we, for us and those who are coming after us, how do we make the tech affordable and the finance accessible, combine the two and make it make sense. Yeah.
Amazing. Thank you, everyone. Thank you. I think we kept a little bit of time, but yeah, thanks, Rich. Thank you for the panel.